Have you ever wondered how a simple tulip flower could crash an entire economy, or how the internet boom turned into a bust almost overnight? Let's dive into some of history's most spectacular financial bubbles, from the wild ride of Tulip Mania to the dizzying heights and sudden downfall of the dot-com crash. Number 10. The South Sea Bubble, 1720. In the early 18th century, the term bubble was coined, symbolizing a financial boom and bust when the South Sea Company in Britain imploded, wiping out many investors' fortunes. This ill-fated venture began in 1711, promising to handle Britain's war debt in return for exclusive trade rights in South America. Despite limited success, Spain dominated South American trade. In 1720, strategic bribes allowed the South Sea Company to assume Britain's entire national debt. They spread tales of immense wealth from the South Seas, issuing numerous stock offerings to the public. Investors could pay in installments, sparking a frenzy among people from all walks of life. Stock prices skyrocketed from £128 in January to £1,000 by June. However, a selling frenzy soon caused prices to plummet to £124 by December, devastating thousands of investors. Government probes unveiled the corruption and bribery at play, leading to arrests of several politicians and company executives. Number 9. The Mississippi Bubble, 1716. In 1716, France faced severe government debts and currency shortages. To address this, the French regent enlisted John Law, a Scottish financial genius and gambler, who suggested using paper currency to revive the economy. Law founded a bank and issued paper notes supposedly backed by gold and silver. The following year, he established the Mississippi Company, granted a monopoly over France's Louisiana territory and its rumored gold deposits. Stock sales soared as Law exchanged shares for government bonds and paper notes, with prices skyrocketing from 500 to 18,000 livres within a year. Initially, Law's plan boosted the economy and enriched many, but the Mississippi Company failed to uncover riches in the Americas. Overprinting of paper money led to soaring inflation. The collapse came in 1720 when wary investors sought to redeem their paper notes, discovering insufficient gold to cover their claims. This sparked bank runs, crashing Mississippi Company shares and leaving many newfound millionaires penniless. Law, fearing for his life, fled the country in disguise. Number 8. The Florida Land Boom, 1920. In the 1920s, Florida emerged as America's tropical paradise, attracting droves of people looking for affordable property and a laid-back lifestyle. The real estate market went wild, with land prices skyrocketing and doubling every few months. Many speculators didn't even have the funds for their purchases, making only down payments and flipping properties for quick profits. The market soon became a haven for swindlers, including Charles Ponzi, who infamously sold worthless swampland to unsuspecting buyers. The bubble seemed endless until early 1926, when building supplies dwindled and buyers vanished. Investors faced massive losses, and a devastating hurricane later that year crushed the market further. By 1928, Florida's bank clearings plummeted from over $1 billion to less than $150 million, marking the end of the wild real estate frenzy. Number 7. Railway Mania, 1840. The 1840s in Britain saw the railroad industry ignite a speculative frenzy akin to a tech boom. Proposals for hundreds of new rail lines emerged, each more grandiose than the last, driving market prices to extraordinary heights. Parliament approved over 9,000 miles of new track, and the investment in railways at one point surpassed the government's military expenditure twofold. Despite the hype, the railroad industry turned out to be more volatile than expected. By 1845, the bubble burst, leading to a prolonged crash. By 1850, many investments had plummeted to less than half their original value, causing widespread financial distress. Even renowned novelist Charlotte Bronte suffered, watching her shares drop from £120 to just £20. She lamented, "The business is certainly very bad. Many, very many, are by the late strange railway system deprived almost of their daily bread." Number 6. The Wall Street Crash of 1929. During the Roaring Twenties, the U.S. stock market experienced unprecedented growth, drawing in countless Americans eager to get rich. Many invested with borrowed money, leading to a more than fourfold increase in the market from 1920 to 1929. This surge in speculation, with banks even using customers' funds without consent, pushed stock prices to unsustainable levels. Despite concerns about the economy's underlying weaknesses, experts insisted the bull market would persist. However, on October 24, 1929, Black Thursday, everything changed. A massive sell-off caused stocks to plummet, overwhelming Wall Street's ticker systems with 13 million trades. The crash intensified on Black Tuesday, erasing billions of dollars from the economy and causing around 4,000 banks to collapse by 1933. This financial catastrophe triggered the Great Depression, a decade-long economic struggle for the United States. Number 5. Bitcoin, 2021. Bitcoin's dramatic rise and fall from early 2020 to 2022 showcased a modern financial bubble in the making. Its value soared tenfold before plummeting by 75%, and its future trajectory remains uncertain. Despite its significant volatility, Bitcoin's market cap peaked at just over $1 trillion in November 2021. When it hit a local bottom, it had shed about $800 billion in value. In comparison to the massive U.S. stock market, valued at around $30 trillion, Bitcoin's scale remains relatively small. Although it garners substantial attention on finance Twitter, FinTwit, Bitcoin's market cap is still too modest to rival the giants of financial bubbles. Number 4. U.S. housing, 2007. The colossal U.S. housing bubble of 2007 stands as a monumental example of economic upheaval. Visuals from Zillow reveal a staggering drop in the residential housing market, plummeting from a peak value of $29.2 trillion to $22.7 trillion by 2012, a jaw-dropping $6.5 trillion loss over just 5 years. However, the U.S. housing bubble's price shifts were surprisingly stable compared to other financial bubbles. Between 2000 and 2007, the median U.S. house price climbed by about 70%, or 7.9% annually. Although some markets exhibited more volatile behavior, the overall price increase was less than double, and housing prices bounced back within a decade. While the sheer size of this bubble is undeniable, its moderate price fluctuations and relatively swift recovery prevent it from being the most spectacular financial bubble in history. Number 3. Dot-com, 2000. The dot-com bubble, peaking in March 2000, saw Nasdaq prices soar tenfold from 1990, reaching a market cap of $6.6 trillion. The subsequent crash obliterated $5.1 trillion in market value, a loss that took 13 years to recover. Initially hailed as the ultimate asset bubble, the dot-com crash transformed once brilliant ideas into perceived absurdities by 2000. Iconic failures like Pets.com exemplified this drastic shift. Yet, intriguingly, many of those ideas are thriving today, with companies like Chewy, acquired for $3 billion, validating early visions. The intriguing aspect of the dot-com bubble, as Andreessen notes, is not that it was fundamentally flawed, it was simply ahead of its time. This nuance adds a layer of complexity to its story, making it one of the most fascinating financial bubbles ever witnessed. Number 2. Tulip Mania, 1637. In 1637, the world witnessed one of history's most extraordinary speculative bubbles, Tulip Mania. This frenzy saw the humble tulip, a flower of limited practical use, reach astronomical prices. Tulips, often symbols of love, became symbols of financial ruin in 17th century Holland. Introduced to Europe in the mid-16th century, these flowers quickly captivated the Dutch. They evolved into powerful status symbols, with everyone from nobles to middle-class citizens vying for the rarest specimens. By the 1630s, tulip markets were bustling in city centers, with bulbs traded like modern stocks. Remarkably, a single tulip bulb could fetch the price of a carriage and horses, or even 1,000 pounds of cheese. The craze escalated until February 1637, when the market suddenly collapsed as major investors began to sell. Prices plummeted, triggering a panic as others rushed to offload their bulbs. As Charles Mackay later wrote, substantial merchants were reduced almost to beggary, and many noble houses saw their fortunes ruined. The Dutch government intervened, but the damage was done, leading to a minor economic depression. Number 1. Japan, 1989. The late 1980s saw Japan reach an unparalleled economic peak. At its height, the Japanese Imperial Palace was valued higher than all the real estate in California, and the stock market had surged tenfold over the previous decade. However, this boom was followed by a dramatic bust. Over the past 33 years, neither Japanese stocks nor residential real estate have fully recovered. Specifically, the stock market lost over $2 trillion, while land values plummeted by $8 trillion from their peak in the late 1980s and early 1990s. If you enjoyed this deep dive into the world of economic extravagance and want to see more captivating content, make sure to hit that like button and subscribe to our channel.